This is how you can avoid costly mistakes as a first time home buyer. Here are 5 first timer mistakes that I want to help you avoid. One is first time home buyers don't know the pros and cons of the different loans and first time home buyer programs. Two, they do the right thing, but in the wrong order. And three, they get intimidated by the numbers. Another mistake that we see is that they don't hire warriors. And first time homebuyers have a weak or non existent offer strategy. Hey, it's Alex, your mortgage and real estate advisor. On the mortgage side, I'm a mortgage loan officer with Nexa Mortgage with over 900 five-star reviews on Zillow. We are one of the largest independent brokerages in the nation, covering 48 states. And we shop over 250 lenders, so you don't have to, which allows us to get lenders to compete for your business and give you the best rates. On the real estate side, I'm with the Rise Group at Real Brokerage. We have over 600 five-star reviews on Zillow. I'm based here in Los Angeles and cover all of California, but I have a team, as mentioned, that covers all 48 states. Mistake number one: first time home buyers don't know the pros and cons of first time home buyer programs and loans. Some of the most popular loans and first time home buyer programs that you might have heard of are down payment assistance, FHA loans, and perhaps maybe conventional loans. Here are some of the pros of down payment assistance programs. One, you get anywhere from 3 to 5% towards the down payment of your new home. And some programs even go up to 20% down payment assistance. These are either grants or second mortgages. They are maybe either forgivable, they may have no interest, or they may have no payment until the property is sold, refinanced, or paid off. Now, some of the negatives to a down payment assistance program are the income requirements. Sometimes your income can't be above a certain amount in order to qualify, but at the same time, your income level can be too low in order to qualify for that home. So it's almost like threading a needle. There may be area limitations, such as area median incomes or demographics. So you may be limited with some down payment assistance programs. You may have a first generation buyer requirement, meaning that your parents can't have owned a home in the last 3, in some cases 7 years, in order to qualify. Sometimes you may have to win by lottery. Another negative is that funds ultimately run out. And one of the biggest negatives is the perception when making offers. Now, this is something that I don't agree with because I believe an offer is an offer, but sometimes sellers look at down payment assistance programs as a negative and usually opt to go with another offer that doesn't have a down payment assistance program. So sometimes down payment assistance programs might put you at the bottom of all other offers. I give you this information not to discourage you, but just to make you aware. But there are ways that we can still win a home with down payment assistance. Now let's look at the benefits of FHA loans. So FHA has a low down payment of 3.5%. They have a little more relaxed credit requirements. You can have a credit score of 580 and even as low as 500, but anything under 580 is going to require a 10% down payment. They are a little more laxed on foreclosures, short sales, deed in lieu, and bankruptcies. They are a little more first time home buyer friendly because of that. They do have lower rates than conventional loans, and they have higher debt to income ratio with almost 47% on the front end and almost 57% on the back end. You do have the ability to house hack with an FHA loan. So you can buy a property with 1 to 4 units, and you can use 75% of the rental income to qualify for the home. And another benefit is a streamlined refinance, which if interest rates drop by a good amount and you want to refinance after 6 months, you don't have to prove income, credit, or do an appraisal and just refinance to that lower rate. Now, some of the negatives of an FHA loan is that since you're putting less than 20% down, you're going to have mortgage insurance, which bumps up your monthly payment every month. They do have a stricter home condition guidelines. So the home that you're interested in has to be up to FHA standards. One of the other things that can be a negative is that it has to be your primary residence, so you can't buy a second home or investment property with an FHA loan. And most condos and townhomes are not FHA approved, so you may not be able to get a condo or townhome. You'd have to have your real estate agent check to see if the townhome or condo is FHA approved. If you have federal debt like owing the IRS or student loans, and that is if you're delinquent on them. If you have federal debt that hasn't been paid, then it's not allowed. If you're on time, you shouldn't have a problem. And one of the other negatives of an FHA loan is that you kind of have that same negative perception from sellers with FHA loans. They think of FHA loans as a little riskier and usually opt for a offer that is conventional opposed to FHA. Again, I don't say this to discourage you. If FHA is the best program for you, I would still encourage you to continue looking for a home with an FHA program. Now let's look at conventional loans and the benefits of them. So one of the interesting things with conventional loans is that a lot of people think that FHA has the lowest down payment option, but actually a conventional loan allows you to put as low as 3% down for the purchase of your home. So you can put anywhere from 3 to 5%. There is no upfront mortgage insurance, which is a plus. On FHA, you do have upfront insurance and your monthly mortgage insurance. With conventional, there's no upfront mortgage insurance and you have a monthly mortgage insurance. So with conventional, you have no upfront mortgage insurance and your mortgage insurance may be lower depending on your credit. Their property guidelines are a little more relaxed, so it doesn't have to meet FHA guidelines. There wouldn't be any problem with chipped paint, cracked glass, as long as the home is livable. It can still be a little beaten up and it would qualify for a conventional loan. You also can house hack with a conventional loan. You can buy 1 to 4 units. One of the biggest benefits of a conventional loan is that they're favored when making offers. There are negatives to a conventional loan is one, of course, as with FHA, if you're putting anything less than 20% down, you're going to have mortgage insurance. They're a little stricter on credit requirements. You do need a 620 or better, but usually it's best if you have a 680 credit score or better. They're a little stricter when it comes to foreclosures, short sales, deed and liens, and bankruptcies. They actually have a lower debt to income ratio, not higher. I'm going to have to edit this here. So you have a lower debt to income of almost 50%. And for those reasons, it's not as first time home buyer friendly. But if you have a 680 or better, or maybe even 620, you can look at the variety of options to see what the loan program is best for you. Mistake number 2. First time home buyers do the right things, but in the wrong order. Here's the way that you don't want to buy a home. This might sound familiar to some of you. 1, you stalk Zillow for months, if not years. Disqualify yourself based on credit, income, down payment without really knowing if you're qualified or not. You may get curious and go see homes. Maybe you see an open house sign, you see a house on Zillow, see a sign in a certain neighborhood, you call, you set up time to go see the home. You fall in love with a house, and then you get rushed through the process, through pre-approval, offer, and ultimately fail because you weren't prepared. And then you rinse and repeat and go through the same process until you get discouraged and then stop looking. So don't try this at home, folks. Most realtors and lenders only care about the transaction instead of really understanding what's right for you. So we do things a little bit differently. We like to lead with value for you and your family and really start with focusing on understanding the before buying a home process. Really preparing, planning, understanding your goals and needs, and creating a more intentional process before buying or selling to ensure that the strategy fits your short-term and long-term goals. That's really 30% of our value. Then you have the during stage when you're in contract. That is where we see that 10% of our value comes, and it allows you to experience excitement of the home buying process instead of anxiety of a typical real estate transaction. One of our biggest values is really the after buying a home, the building wealth. That's 60% of the value that we offer. We want to help you accomplish your real estate and financial goals through our advice and our network of professionals. Now, this is our bulletproof home buyer process, which consists of 7 steps. Step number one would be an initial consultation, us jumping on Zoom or a call to really discuss and understand your overall dreams and goals and discuss market conditions, strategies, provide you with a home buyer guide. Step two, we discuss the mortgage and pre approval strategy. Really, to help determine your buyer ability, we refine the search price range, and we assist you in making your offer more competitive, regardless of whether you are a down payment assistance, FHA, or conventional buyer. Step three would be to define your home buying goals and home search criteria, discuss various property types and locations, work within the confines of your pre approval, search MLS both on and off market. Those are the first 3 steps that we go through even before looking at homes. So we really have a good strategy going into the home buying process. Then we go view properties, select a home, we prepare, submit, and negotiate offers. Step six, the contract is accepted. We go through escrow, inspections, appraisals, and ultimately close on your home. And our final step is our long term commitment to evaluating your financial needs outside of the home, providing you with maintenance service providers to maximize your home's value. We constantly manage your mortgage and try and see if we can save you any money in your mortgage. And every year, review your overall real estate and financial goals and see how we can help. Mistake number 3, first time home buyers get intimidated by the numbers. Have you heard of these terms when buying a home? Rate or interest rate, days on market, inventory, credit score, earnest money deposit, closing costs, homeowners insurance, inspection, appraisal, points, taxes, recording. What does all of this mean? Well, let's jump into that. So the rate is really the cost of borrowing money. It ultimately depends on your credit. My goal as your lender is to ultimately get you the best rate. Currently, rates are in the low to high sixes, depending on credit. Now, this is not a quote. This is just for educational purposes only. A quick question for you on that. What do you think will happen to home prices if rates went down to 5%? Most people will say, well, home prices will probably go up. And they're most likely right. Historically, when headline inflation is above 5% and unemployment is below 5%, there is a 100% chance of a recession. And this happened in Q4 of 2021. Let me tell you what that means. Mortgage rates plummet in recessions. So I like looking at the history of recessions that happened in the past so I get a better idea of what might happen in the future. So we can see that during the recession of 1974, interest rates went from 10% to 9%. In the 1980s, we had a double dip recession where they went from 16% to 11.75%, and then bumped up to 18% and dropped down 13% and kept dropping from there. Then we had the recession in 1991. Interest rates were at 11% and dropped to 8.75%. Then we had the recession in the early 2000s, your dot-com bubble. And at that time, interest rates were about 7.375% and dropped down to 6.75%. And of course, we can all remember the housing crash of 2008, where interest rates went from 6% to just below 5%. And of course, more recently, we had a flash crash of the pandemic where interest rates were at 3.75 and dropped down to a historical level of 2.75. Obviously, since then, rates have increased. Now, an interesting thing about these recessions is that house prices have actually gone up in 5 of the last 6 recessions. So if we look at double dip recession of 1980, we had a recession, home prices went up. Same thing a few years later. Then in 1990, we had a recession, home prices continued to rise. We had the dot-com bubble of the early 2000s until we hit 2008. This was one of the only recessions where we actually saw the home prices drop because most likely the fundamentals were off. We had a big housing bubble that ultimately brought home prices down. Since then, we see that it continued to climb, and during the most recent recession of the pandemic, we can see that home prices really began to accelerate shortly after that. So we can get a better idea of what happens during a recession. Most people have the false notion a housing crash is going to happen. Most people think that the next recession is going to create more opportunities for housing. But if you look at some of these graphs, you may want to think twice. What's interesting is that there are 75% fewer homes on the market today than there were during the market crash of 2008. You can see that in 2008, there were over 4 million homes for sale. Currently, we're around 1 million homes that are available for sale. And you notice that this is the lowest inventory since even before the 2008 recession, where we were at a healthy 2 million homes. Now, I'm in LA County, and these are some of the market trends that, as a real estate agent, I like to look at. So we have this cool little graph that tells us if it's a seller's market, a balanced market, or a buyer's market. And we can see that currently we're in a seller's market. And that's because of the months of inventory. We can see that there's less than 3 months of inventory when it comes to homes, and a balanced market would have 6 months or more. And in order for us to get to a buyer's market, we're going to need more than 9 or 12 months for us to enter a buyer's market. I also like to look at the list to sold price, so we can see that home prices are sold at 102% of their list price. Homes are on the market for about 17 days, and the median sales price here in LA County is $982,000. You may hear a lot of people out there, or maybe even hear it on the news, that home prices are going to crash, home prices are dropping. But if we look back over the last 82 years, home prices have gone up 74 times, and they've only gone down 7. 5 of those were during the recession, where we agree that fundamentals were off. We had a housing bubble. The only other time when house prices went down were in 1990 and 1991. And then in 1955, we can see that house prices didn't go up or down that year. But for 90% of the time, home prices continue to have gone up. So based on this data, how certain are you that home prices are going to drop? Now, getting back to the numbers, credit score. That's a very important number that we're all very concerned about. Ultimately, a credit score is your measurement of risk that a lender looks at. And lenders primarily look at your credit score from the top 3 credit reporting agencies, which is Experian, Equifax, and TransUnion. Like me, you probably have a Credit Karma, which allows you to see what your credit score is. The interesting thing about Credit Karma is that it's not entirely accurate because they measure credit based on what's called a Vantage score, not a FICO score like Experian and Equifax and the others. Take the Credit Karma credit score with a grain of salt. Now, what is your credit score based from? So 35% of your credit score is based off your payment history, meaning do you pay your bills on time? 30% of your credit score is based on your credit utilization. Generally, you want to keep that under 30%. And credit utilization means, what percentage of your total credit are you actually using? For instance, if you have a $1,000 credit card and purchase something for $300, then your credit utilization would be 30%. So generally, you want to keep it under 30%. 15% of your credit score is based on the length of your credit history, how long you've actually been using credit cards, loans, car payments, whatever the case may be. 10% is based on new credit, any new credit established. And then 10% is a credit mix. So what type of credit lines do you have? Is it just department stores, or do you have credit cards, car payments, personal loans? Just a mix of credits is what this measures. FHA requires a 580 credit score, and you can go as low as 500 with a 10% down payment, opposed to a 3.5 with a 580. Conventional loans usually require a 620 credit score, but ideally a 680 or better. VA loans require a 620 credit score and above. Now, an earnest money deposit is the initial deposit that you make to show that you're a serious buyer. Typically, that's 3% of the purchase price. Now, your earnest money deposit goes towards your down payment, and your deposit is protected by three major contingencies. One is the inspection contingency. So if you go in, do your inspection, and you find something that you don't like, you can cancel the contract and get your deposit back. Then you have the appraisal contingency. If the home doesn't appraise for the purchase price that you agreed upon, then you can cancel the contract and get your deposit back. Finally, you have the loan contingency. If for some reason your lender can't close your loan, you do have the ability to cancel the contract, get your deposit back. Now, although these contingencies are there to protect your deposit, you can also use these contingencies to negotiate further on the purchase of your new home. So just keep that in mind. And one of the interesting things with lenders, 1 in 6 transactions fall out of escrow. So it's very important to have a really good lender and a really good real estate agent, because not only do you risk losing out on the home of your dreams, but you may also lose out on your deposit. Now, what are closing costs? That is the $1 million question. Now here I'll break down a few of the closing costs that you can expect. One, you have the origination charges. This is what your lender charges, whether it's points that you're buying to bring the rate down. Maybe there's a loan origination fee, underwriting fee. Those are your origination charges. Then you have services that you cannot shop for, such as appraisal fee, credit report fee, processing fee. Then you have services you can't shop for, such as escrow and title. Other costs include taxes and other government fees, such as recording fees, taxes, transfer taxes. You have prepaids, such as homeowners insurance, mortgage insurance, prepaid interest, prepaid taxes. And then you have initial escrow payment at closing, such as homeowners insurance, mortgage insurance, and property taxes. Those are just some of the closing costs that you can expect, and they usually range anywhere from 2 to 5% of the purchase price. So the bad news is closing costs are expensive. The great news is you can have someone else pay them. There are closing cost assistance programs, or depending on the market, we can ask the seller to pay for the closing costs. Ultimately, it's all about the monthly payment. Not only a monthly payment that you can afford, but a monthly payment that you're comfortable with. It's the monthly payment that's really going to tell us how much home we can afford. Mistake number 4, first-time home buyers don't hire warriors. What do I mean by that? Any realtor can open a lockbox. Any lender can quote your rate and get you pre-approved. A realtor's job isn't to show you houses, and a lender's job isn't to show you rates. Their job is to pick up the sword and fight for you. They also use their shield to protect you from harm. So before stepping into a home, a realtor will understand your dreams and goals. They will provide you with a buyer consultation and really understand the before, during, and after, and deliver market insights and create a competitive offer strategy to win the home that you want. A warrior lender will strengthen your buyer ability. They will pit hundreds of lenders against each other to compete for your business and to give you the best rate. They will build an armored loan file to conquer underwriting approval and to ultimately get the clear to close, which means that we can close on your new home. Now, what do you know about how realtors are compensated? So historically, and what we see continuing, is that realtors will be compensated on a percentage of the purchase price, which is an average of 3%. Now, you might have heard in the news the new NAR law, which means that a signed agreement will be required before actually seeing a home. So that could be an agreement for either just that home, just that city, or just that county. So it's very important that you have a really good realtor. Now, here are some representation strategies for your buyer agent to be compensated. So what we foresee continuing is a seller paid compensation. Ultimately, what will happen here is that the seller will be paying the compensation of the buyer's agent. So for instance, on this purchase price of $500,000 with a loan amount of $400,000 and an interest rate of 6 3/4 and an APR of 6.9. Now, this is not a quote. This is just for educational purposes. The payment on this home would be about $3,052 with cash to close of $111,275. So this is what we will be fighting for. Another option will be to add the compensation to the price. So in this case, the price would be 515 with a loan amount of 412, same interest rate and APR. The payment on this would be about 3144 with a cash close of 114,000. Third option would be to add the compensation to the loan. This would keep the purchase price the same, 500,000 with a loan amount of 415, same interest rate, same APR. The payment is 3184 with a cash close of 111,000. If for some reason all that fails, which I don't presume, there is the buyer paid compensation option, where essentially the purchase price would be 500,000, loan amount would be 400,000, and everything remains the same, and your cash close would be around 126,000. So those are just a few representation strategies that can be utilized. But again, the goal is getting that compensation paid by the seller. Now, what do you know about how lenders are compensated? This is even a little more elusive than when it comes to realtors. If a lender tells you that they only charge $19.99, $14.99, or they don't charge anything, they're probably not being honest. There are three ways that lenders get paid because nobody works for free. One of those ways is through an origination cost. Another way is financing it through the rate, or a combination of origination and financing it in the rate. So those are the main three ways that lenders get paid. And I'll show you an example in a minute. Now, if for some reason you get a very low rate and no origination costs, most likely the way that they're being compensating is through the servicing. Now, anytime you have a loan, there is a servicing fee attached to it. So servicing is another way that lenders are compensated, even when they're telling you that they have the lowest rate and no origination fee. For the most part, all lenders generally get paid the same. They just move around the numbers differently. The maximum lender compensation is 3% of the loan amount. And just to tell you a little bit about that compensation, that 3% doesn't go to that mortgage loan officer. Essentially, that gets broken up into a few pieces. One, the brokerage gets their piece. The mortgage loan officer gets their piece, and of course that goes into marketing, administration, and education. And here are three different scenarios just to break down the numbers for you a little further. So in scenario number one, we have a loan amount of 412,000, interest rate of 5.5%. Your monthly estimated payment would be around $3,200 a month, with an estimated closing cost of $24,000 and $161,000 cash to close. And remember, we may be able to get these closing costs paid either with a closing cost assistance program or getting the seller to pay for that. And now this is based on a 20% down payment, so that's why you see a big amount needed here for the cash to close. So for scenario number two, same loan amount, $412,000, interest rate is higher at 6.625, with a monthly estimated payment of about $3,500. Estimated closing cost is about $16,000, with estimated cash to close of $153,000. Then in scenario number three, same loan amount, interest rate of 5.99, with a monthly estimated payment of $3,300. Estimated closing costs are $20,000, with an estimated cash close of $157,000. We can see that scenario number one has the lowest interest rate, the lowest payment, but the highest closing costs. We can see that in scenario number two, we have the highest rate, highest payment with the lowest closing costs. And scenario number three is right in the middle with a medium interest rate, a medium monthly payment, and a medium closing cost. Now, the interesting thing about these three scenarios is that the lender is getting paid the same in all these three scenarios. The numbers are just moved around differently. So you can see that anybody can show you a low rate, anybody can show you low closing costs. It's just how the numbers are moved around. And for that reason, you shouldn't just focus on the rate or on the closing costs. Ultimately, what's more important is, do you like the lender? Does the lender care about your goals and your dreams? And is your lender going to help you not only now, but in the future to achieve your real estate and financial goals? So focus on the lender, not the rates. Mistake number 5, first-time home buyers have a weak offer strategy. Let me explain. So how do first-time home buyers compete with other buyers in the market. Here is, in essence, a hierarchy of the other types of buyers out in the market. The buyer that is at the top is usually a cash buyer, and 34% of homes sell for cash. On the second page, you have buyers with 20% down on a conventional loan. The third option for sellers are buyers with 5 to 10% down with a conventional loan. Then you have buyers with 3 to 5% down FHA. And finally, you have buyers with down payment assistance on FHA or conventional. That's generally the hierarchy of how offers are seen by sellers and selling agents. Now, again, I don't want to discourage if you're a buyer with down payment assistance or if you're a buyer with an FHA loan. There are still ways that you can win with these type of loans. One of the ways that you can do that is by partnering with a good realtor. Now, how do you know you have a good realtor? Well, a good realtor is going to give you value ahead of time. They're going to conduct a buyer consultation. They're going to create a strategy based on your unique situation. And your realtor should be familiar with negotiating down payment assistance, FHA, or conventional. Ultimately, you want a realtor that can communicate your offer in the best light and set you apart from other offers. And I'd be more than happy to refer you to a good realtor in my network. Now, this is how you can get your offer accepted, even if you're not the strongest offer. One is take your realtor's advice. They're there to help you win. They conduct comp analysis, communicate with sellers. They have agent relationship. They have market insights and understand the trends. Make sure that you heed your realtor's advice. You also want to be competitive. You want to make sure that you're putting your best foot forward with your best offer. Speed is critical in home buying. So you want to be the fastest offer, the fastest at the negotiating table, and the fastest to close. Ultimately, being fast can actually help your chances of getting your offer accepted, even if you're not the highest offer. You can also request less seller credits and ultimately decrease the time to close escrow. That ultimately is going to improve your chances of getting your offer accepted and closing on your home. Because if you find a home that you liked, it's most likely that someone else is looking at that home too. And time kills deals. Another way to win is getting a fully underwritten loan approval. This is how finance buyers can compete with those cash offers. So finance buyers can compete by completing the pre-underwriting, getting fully approved outside of property, title, and appraisal. Ultimately, this underwritten loan approval is as good as cash. Some of the requirements to get an underwritten loan approval is that you have to be actively making offers in the next 30 days. You have to be ready to provide all documentation for underwriting. And you have to hire a warrior realtor that's an expert in negotiating offers. So what's next? Book your bulletproof buyer consultation. During this call, we'll go through discovery and really understand your dreams and goals, provide you with market insights and trends, and deliver a home buyer's guide. We will also review mortgage and pre-approval strategy. We will determine your buyer ability, refine search price range, and make your offer more competitive with that fully underwritten approval and provide you with a pre-approval letter. We will also define your home buying goals and home search. We will look at a variety of different property types and locations, create a targeted search, and look at not only active inventory, but passive inventory and locked inventory. And if needed, I can connect you with a realtor as well. So let's start your house shopping and click the link below to book your call. I'm excited to help you on your journey home.